Getting back to the part two of the series, the most important part here is on the top of page 184. The journalizing and posting of closing entries. And step one is if you take a look at the revenue and expense accounts, you're going to add a new entry into each of those. And it's going to be a closing entry, which is the opposite of the debit that you've got. So if you've got a debit revenue account for its balance credit, you're going to debit each revenue account for its balance, and you're going to credit each expense count, which is the opposite of what you've been doing when posting. And you're going to credit net income or debit net loss to the owner's capital account, which is how you connect the operating part of the reports from the profit and loss into the owner's equity, which is then also now part of the balance sheet. So what does that do? It allows you to reset all of your revenue and expense accounts to zero, so that in the next period, whether it's the month or the year, you're going to start off with a brand new revenue and expense calculation so you can find the revenue and expense and profit for each of those periods that will be coming. At this point, you can prepare a closing balance, and that should provide you with the zero expense accounts, the zero revenue accounts. And to get a report, you can take the reports as you hand manually off of the 1, 2, and 3 accounts for the balance sheet, and it'll be the owner's statement of equity. You'll have prepared the P&L from the prior month before you put in the closing balances. The next part that the chapter goes into is starting to look at some of the ratios that occur when you start to look at the information you've generated in the reporting. So the part of what you want to know is are you liquid? In other words, can you pay your bills? And the solvency, are you in an ongoing situation, or are you going to have to go out and go bankrupt, close, or whatever? And so you want to know what your working capital is and your current ratio is. And the working capital on page 188 is defined as capital assets minus current assets minus current liabilities. And that is also very, very clean. It tells you whether or not you have enough cash on hand to pay your bills, which would be solvency. And the liquidity issue is how fast can it turn into cash. So when you're looking at current assets, you have cash in the bank. You may also include nearby accounts receivable that are sure to be collected, but you'd have to then time that against when you have those proportions. So the current should be really just for the period that you're reporting. But you may look ahead and see, well, I can pay that the first week, and they won't mind if I'm a week late, etc. So working capital, that, and the current ratio at the bottom of page 188 is the current assets divided by the current liabilities. And hopefully that's a greater than 1 calculation. Less than 1 would mean that you're, it was a 0.68, would mean that you don't have enough current assets to pay your current liabilities. Now, if it's multiple, then you're in great shape. And what you're trying to find out is how healthy is your current cash position so that you can continue the business. And then the end of period spreadsheet is, I think, what we talked about with a 6-column spreadsheet. I've never really used these. I've always just relied upon the reports and the cash flow statements that are generated by the computer. You can review those if you like, you can use them if you like, and it's a lot of pencil work, and I'm not sure you gain much from it. So then you prepare the financial statements. Page 196, reversing entries. Some adjusting entries recorded at the end of the accounting period affect how transactions are recorded in the next period. For this reason, some companies add another step to the accounting cycle. There's an additional step. Journal entries on the first day of the next period are the exact opposite of the related adjusting entries on the last day of the last period, and these are called reversing entries rather than the closing entries. You may have certain accounts like wages payable then have to be adjusted or carried because you still owe them. And you want to reverse that cancellation done by the closing entries. I would take a look at the problems, and we'll be discussing this further on next Thursday, reviewing completing the accounting cycle and some of the problems that are occurring. And then in the following week, we're going to go over Chapter 5, which is going to talk a little bit more about the accounting system. So thank you, and again, we'll talk about these, and my apologies for Thursday night. It was not expected or desired, so hopefully we'll be able to catch up a little bit better next Thursday.